You are researching negative working capital. You probably found a company that reports a negative working capital, and yet, by all other financial measures, the company appears strong and it has no problem paying its creditors on time. In most cases, there is a very simple explanation. Do this. Look again at the balance sheet of the company you are studying. Look at its current liabilities. Do you see an account called the current portion of long-term debt, or possibly current portion of long-term maturities? Either way, that's the problem. Other videos on this topic typically start by listing the common current assets and current liabilities, something like this. But all of them leave out this important current liability, the current portion of long-term debt, CPLTD. That is intentional. They leave it out because they want to focus narrowly on the trading cycle. The trading cycle traces the natural flow of funds from suppliers, that is, accounts payable, to inventory, to accounts receivable, to cash, and then back to repay creditors. This is a very important part of financial analysis. Indeed, measuring the timing of these steps is the basis for the analysis called the cash conversion cycle. But notice, where in this cycle is the current portion of long-term debt? The current portion of long-term debt is a current liability, but it's not part of the trading cycle. Why? Because it comes from the fixed asset cycle. The fixed asset cycle is the logical complement to the trading cycle. Let's say you are a young entrepreneur. You want to buy a truck that you can use to provide moving and hauling services. Your bank grants you a loan to buy the truck because it believes that you can use the truck to generate cash to repay the loan. The loan is a long-term debt because it requires you to make principal payments for 5 years. The portion of the loan that you must repay in the current year is the current portion of your long-term debt, which must be reported as a current liability. Here's the problem. Including the current portion of long-term debt in current liabilities suggests that it must be covered by short-term assets, principally accounts receivable and inventory. That is wrong. Think about it. You bought a truck. You have no accounts receivable because your customers pay when the service is provided. You have no inventory nor accounts payable because you do not buy and sell any products, only services. And you probably have no prepaid or accrued expenses to speak of. You have one large current liability, the thousands of dollars you must pay to the bank this year on your truck loan. And you only have a few dollars in cash in your pocket to buy gas and lunch. Your current liabilities far exceed your current assets. Your working capital is very negative. Are you illiquid? How are you going to pay your truck loan? The purpose of the loan was to buy a truck, a fixed asset, which you will use to generate revenue to repay the loan. You do not need accounts receivable or inventory. Our little one-truck company has something in common with the giant AT&T. AT&T reports a multi-billion-dollar negative working capital every year. What they have in common is they both invested heavily in fixed assets financed by long-term debt. So both report a large current portion of long-term debt in current liabilities, which causes their current liabilities to exceed their current assets, making working capital appear to be negative. But negative working capital is a false indicator of illiquidity. Both companies are liquid because both will use their extensive fixed assets to repay their long-term debt. Some analysts have already figured this out. What they do and what you can do is simply remove CPLTD from the calculation. Specifically, we remove CPLTD from current liabilities, which reduces current liabilities and will usually change a negative working capital into a positive. Analysts may call the result something like adjusted working capital, which is a valid and very useful concept because by excluding CPLTD, it now agrees with the analysis of the trading cycle, which also excludes CPLTD. But let's be clear. Adjusted working capital is not working capital. The current portion of long-term debt is a current liability and it must be included in the calculation of working capital. So is there a different way to correct the formula that preserves the original definition while eliminating the false negatives? That is a truly exciting and provocative topic because it turns out there is an account missing from the balance sheet. The Journal of Accountancy calls it the missing piece in liquidity calculations. You can read or download this article on my website, or stay tuned, and I will walk you through this fascinating discovery in my next video entitled Negative Working Capital is a Miscalculation. And please, I hope you like this. Thank you very much.